Con Talks.
Welcome everyone to Econ Talks, where we dissect the most pressing economic issues of our time. Today, we are diving deep into a topic that has fundamentally reshaped central banking over the past 2 decades: unconventional monetary policy. From its genesis and crisis to its potential role in the future, we will explore its tools, assess its effectiveness, and consider its far-reaching implications. I'm Somladun, and joining me today are 3 distinguished guests. First, we have Professor Nimal Hamu from Cherokee College.
Thank you, Sonam. Great to be here.
Next, we have Professor Kinzang Yangchen from Royal Thimphu College.
Thank you for inviting.
And finally, we have Professor Anjali Rai from Gedu College of Business Studies.
Thank you.
Segment 1. The Genesis of Unconventional Monetary Policy.
Let's kick things off with the why. Conventional monetary policy primarily relies on adjusting short-term interest rates, but starting with Japan's lost decades in the 1980s and then empathetically during the 2008 global financial crisis, central banks found themselves hitting the zero lower bound. Professor Nima, could you set the stage for us? What prompted this unprecedented shift to unconventional tools?
Absolutely, Sonam. The zero lower bound was the primary catalyst. When a central bank lowers its policy rate to near zero and the economy still requires further stimulus, conventional tools become ineffective. This is precisely what happened in Japan and then on a massive scale during the global financial crisis. The financial system was seizing up, credit channels were blocked, and deflationary spirals were a real threat. Central banks couldn't cut rates further, so they had to innovate. They essentially needed to find ways to influence longer-term interest rates and directly inject liquidity into the financial system, bypassing the traditional interest rate channels.
From a market perspective, it was a period of extreme uncertainty. Liquidity had dried up and fear was rampant. Central banks stepping in with these unconventional measures, particularly large asset purchases, sent a powerful signal. It wasn't just about the mechanics of buying bonds, it was about the central banks demonstrating its commitment to preventing a complete financial meltdown and supporting the economy.
And from a fiscal perspective, it's crucial to remember that governments were also facing immense pressure. The global financial crisis led to significant declines in tax revenue and increased demands for social safety nets. Conventional fiscal stimulus was implemented, but there were also limits to how much debt governments could credibly take on, especially as their economics contracted. Unconventional monetary policy, by keeping borrowing costs low, inadvertently created fiscal space for governments, even if that wasn't its primary objective. It is the pressure on governments to cut spending or raise taxes during a recession which would have been counterproductive.
That's great, Professor Anjali. Professor Nima, could you elaborate on the types of unconventional tools that emerged? What were the main categories central banks adopted?
Certainly, we can broadly categorize them into a few key areas. Quantitative easing, this is perhaps the most well-known. It involves large-scale asset purchases by the central bank, typically government bonds and sometimes other assets like mortgage-backed securities. The idea is to directly lower long-term interest rates by increasing demand for these assets, thereby pushing up their prices and lowering their yields. It also expands the central bank's balance sheet significantly. The Federal Reserve various rounds of quantitative easing and the European Central Bank asset purchase program are prime examples. Secondly, forward guidance. This involves explicit communication from the central bank about the future path of monetary policy. The aim is to manage market expectation of future interest rates and inflation. It can be time-past or state contingent. The Bank of Canada, the Fed, and the European Central Bank all utilize forms of forward guidance. The lower for longer narrative became very prominent. And then negative interest rate policies. A handful of central banks, notably the European Central Bank, the Bank of Japan, the Swiss National Bank, and the Riksbank, implemented negative policy rates. This means commercial banks were charged for holding reserves at the central bank, aiming to incentivize them to lend rather than hoard cash. This was truly radical departure.
From a market participant's perspective, quantitative easing was transformative. It directly influenced the yield curve. When the Fed was buying treasuries and mortgage-backed securities, it effectively became a massive buyer, driving down yield across the curve. They incentivized investors to move into riskier assets, equities, corporate bonds, in search of yield, contributing to the portfolio rebalancing channel. Forward guidance, when credible, also had a significant impact on market expectations. If the central bank clearly signaled a lower for longer policy, it removed uncertainty about future rate hikes, allowing investors to price assets accordingly. Negative interest rate policy was more controversial from a market perspective, as it compressed bank net interest margin and created operational challenges for some financial institutions.
And the sheer scale of these operations, especially quantitative easing, fundamentally changed the landscape of central bank balance sheets. They ballooned to unprecedented sizes, raising questions about their eventual unwinding and potential market distortions. The blurring of these lines between monetary and fiscal policy also became a significant debate point, particularly when central banks brought large quantities of government debt. While technically separate, the economic effect of central bank buying government bonds are resemble debt monetization to some observers, even if it's done in the secondary market.
Segment 2. Effectiveness and transmission channels.
We have established the what. Now let's turn to how the effective and the mechanisms through which these unconventional policies were intended to work. Professor Nima, from a theoretical standpoint, how do these tools transmit their effects to the real economy, and what does the empirical evidence suggest about their success?
Fundamentally, these policies operate through several key transmission channels aiming to circumvent the constraints of the zero lower bound. Portfolio rebalancing channel. Firstly, this is central to quantitative easing by purchasing large quantities of long-term safe assets like government bonds. This central bank reduces their supply in the market. This drives up their prices and lowers their yields, making them less attractive to investors. In response, investors rebalance their portfolio towards riskier assets such as corporate bonds, equities, and even real estate, seeking higher returns. This increased demand for riskier assets lowers their yields and boosts their price, stimulating investment and consumption. Followed by signaling channel or confidence channel, forward guidance primarily works through this. By committing to keeping rates low for an extended period, the central bank signals this strong intention to maintain accommodative monetary conditions and to achieve inflation and employment objectives. This reduces uncertainty about future policy, anchors inflation expectations, and can boost confidence among business and consumers, encouraging spending and investment. It also influences long-term interest rates by shaping expectation of the future path of short-term rates. Next, market functioning channel. During crisis, financial markets can become dysfunctional, with liquidity drying up and credit flowing poorly. Central bank asset purchases and liquidity operation can restore market functioning by providing much needed liquidity, reducing risk premiums, and improving investor confidence. This ensures that even if interest rates are low, credit can actually reach the real economy.
I can attest to the direct impact of financial markets. When quantitative easing programs were announced, we saw immediate and often significant reactions in bond yield and equity prices. The search for yield became a dominant theme for investors. With safe assets offering minimal returns, capital flowed into corporate bonds, high yield debt, and equities. This did support asset price and, by extension, corporate funding conditions. For example, during the various phases of quantitative easing, companies found it cheaper to issue debt, and these indirectly supported investment. The signaling effect of forward guidance also played a huge role. For portfolio managers, having a clear indication from the central bank about its intention for the foreseeable future allowed for better planning and risk assessment. It reduced the term premium, the extra yield investor demand for holding longer-term bond, because they were more confident about future short-term rates. However, it also meant that traditional fixed income strategies became very challenging due to suppressed yields.
While the direct impact on financial markets or the prevention of a deeper recession are undeniable, it's also worth noting the macroeconomic context. These policies were a bridge allowing economies to heal and providing time for other policies, including structural reforms, to take effect. They couldn't, on their own, fix underlying structural issues in economics or address issues of long-term productivity growth. Their effectiveness was often enhanced when coupled with supportive fiscal policy. In essence, monetary policy brought time, but it couldn't solve everything. There's also the question of diminishing returns. The initial rounds of quantitative easing probably had the most significant impact. Subsequent rounds might have had less marginal effect.
That's a crucial point, Anjali. Let's delve into some specific examples. Professor Nima, perhaps you can share a case study or two that illustrates the applications and perceived effectiveness of these policies.
Certainly, the Federal Reserve's response to the 2008 global financial crisis is a prime example. After cutting the federal funds rate to near zero, the Fed embarked on multiple rounds of large-scale asset purchases, commonly known as quantitative easing 1, quantitative easing 2, and quantitative easing 3. Quantitative easing 1, initiated in late 2008 and early 2009, focused heavily on purchasing mortgage-backed securities and agency debt alongside longer-term treasuries. This was explicitly aimed at supporting the housing market and unfreezing the mortgage credit market. The consensus is that it largely succeeded in these immediate goals. Subsequent quantitative easing focused more on broader macroeconomic stimulus, aiming to lower long-term rates and reduce unemployment.
Professor Kinzam, from your vantage point, what were the practical challenges and opportunities these policies presented to investors?
The biggest challenge was navigating a low-yield environment. Traditional income strategies were severely impacted. Investors had to either accept lower returns or move further out on the risk curve to achieve their desired yields. This contributed to a phenomenon sometimes referred to as a reaching for yield. For instance, pension funds and insurance companies with long-term liabilities struggled to generate sufficient returns from safe assets and were pushed into higher risk investment. However, there were also opportunities. The consistent liquidity provided by central banks and the surpassed volatility meant that risk assets performed exceptionally well for an extended period. Equity markets saw significant appreciation and corporate bond spread tightened. It was a golden age for carry trades and growth stocks. But it also meant that a lot of capital was deployed and valuation in some sectors became stretched, raising concern about potential asset bubbles. The taper pattern in 2013, when the Fed hinted at scaling back quantitative easing, demonstrated the market sensitivity to even the talk of normalization.
Segment 3, Implications and Critiques.
Let's pivot to the implications and the substantial critiques leveled against unconventional monetary policies. Professor Nima, beyond the intended effects, what are some of the potential side effects and concerns that have emerged from the prolonged use of these tools?
This is a crucial area of debate. While undoubtedly effective in averting deeper crises, these policies also carry significant potential side effects. Firstly, distortion of price signals and resource misallocation. By artificially suppressing interest rates, central banks can distort the price of money and capital. This might lead to malinvestment, where capital flows into less productive ventures that would not be viable at higher, more market-determined interest rates. It can also keep zombie firms alive, companies that are unprofitable but can survive due to cheap debt, hindering creative destruction and overall productive growth. Followed by asset price inflation and inequality. A significant critique is that unconventional policies, particularly quantitative easing, tend to inflate asset prices. While this creates a wealth effect for asset owners, it disproportionately benefits the wealthy who hold more assets, potentially exacerbating wealth inequality. Those without significant asset holdings or who are primarily savers might see their real incomes eroded by low returns on savings and rising cost of living. Next, we have financial stability risks. Prolonged periods of ultra-low interest rates can encourage excessive risk-taking in financial markets, leading to credit booms, asset bubbles, and increased leverage. If these bubbles burst, it could threaten financial stability. Additionally, low interest rate can compress bank profitability, potentially weakening the bank sector. While central banks have introduced macroprudential tools to address this, the risk remains. Now, exit challenges. Unwinding these policies, particularly reducing central bank balance sheets and raising interest rates, present significant challenges. The temper tantrum of 2013 highlighted how even the discussion of normalization can trigger market volatility. A poorly managed exit could lead to sharp rises in bond yields, financial market instability, and even a recession.
From a market perspective, the asset price inflation point is undeniable. While it benefited our portfolios, it also created a disconnect between financial markets and a real economy for a period. We saw robust equity markets even as unemployment remained high. The reaching for yield phenomenon was also a real concern. Investors were taking on more risks than they might have otherwise. The compression of bond yield made diversification challenging as both equity and bond market often moved in the same direction driven by central bank actions.
The fiscal implications are particularly interesting. While unconventional monetary policy did provide governments with lower borrowing costs, which could be seen as beneficial, it also enabled governments to postpone necessary fiscal adjustments. When debt is cheap, there's less pressure to undertake difficult reforms or rein in spending. This can lead to a build-up of public debt to unsustainable levels. There's also the risk of central bank losses if interest rates rise significantly and there are holding long-term duration assets bought at low yields. While theoretically central banks can absorb these losses, in practice they could require recapitalizations from government, again blurring the lines and potentially compromising independence.
Professor Anjali, you touched on central bank independence. This is a big one. So, how do these unconventional measures challenge the traditional notions of central bank autonomy and their mandate?
The traditional mandate of central banks is price stability and, in some cases, maximum unemployment. Unconventional policies, by their very nature, develop deeper into the allocation of credit and the functioning of specific markets, which traditionally were seen as within the purview of fiscal policy or fiscal financial regulation. When a central bank buys mortgage-backed securities, it's explicitly supporting a particular sector. When it offers targeted lending programs, it's influential who gets credit. This moves beyond broad economic stabilization into more economic allocation, which can be seen as picking winners and losers. This inevitably invites more political and pressure. The argument that central banks are doing the government's job or financing government spending becomes more prominent, even if legally distinct. Maintaining credibility and public trust becomes paramount when operating in this space.
Segment 4. The Future and Lessons Learned.
This brings us to the future as we move beyond the immediate crisis that's bound these policies. What does the future hold for unconventional monetary policy? Will they become permanent fixtures in the central bank toolkit, or will we see a return to more conventional approaches? Professor Nima, your thoughts?
That's the billion-dollar question. Sonam, I believe it's unlikely we will fully revert to the pre-global financial crisis era where policy rates were this sole tool. The effective lower bound is a persistent reality, especially with declining neutral real interest rates driven by demographics and productivity trends. So unconventional tools will likely remain part of the central bank's arsenal, particularly during severe downturns. However, we are also seeing a period of monetary policy normalization globally, with central banks raising rates to combat inflation. This provides an opportunity to resist and refine.
From a market perspective, we have clearly moved into a new regime. The idea that interest rates will always be significantly positive seems less likely. Market participants are now accustomed to the possibility of central banks intervening in bond market and using forward guidance. This means that central bank communication and balance sheet policies will continue to be closely watched. The challenge for investors is adapting to a world where monetary policy is more complex and less predictable than the simple short-term rate adjustment. We will likely see greater volatility during periods of policy uncertainty or during exit strategies. The demand for clear, consistent central bank communication will only intensify. Also, understanding the interaction between monetary and fiscal policy will be even more critical for investors going forward.
I think the biggest takeaway from my perspective is the imperative for better policy coordination. Monetary policy cannot be the only game in town. Where interest rates are at zero lower bound, fiscal policy becomes a much more potent tool for demand management. We saw during COVID-19 pandemic how unprecedented monetary policy and fiscal coordination was crucial in stabilizing economics. Going forward, we need to ensure that fiscal policy is agile and responsive during downturns, taking some of the burden of central banks. There's also a need for structural reforms that boost productivity and the natural rate of interest, which would give central banks more conventional policy space. Addressing the distributional impacts of monetary policy will also require fiscal solutions, targeted social programs, wealth taxes, and progressive taxation to mitigate the potential inequality. The indifference of central bank must be preserved, but the boundaries of their actions and their interaction with fiscal authorities need to be clearly defined and understood by the public.
Our time together is unfortunately drawing to a close. This has been a truly illuminating discussion. We have covered the origins, tools, effectiveness, and implications of unconventional monetary policy. It's clear that these tools emerged out of necessity, played a crucial role in stabilizing economies, but also come with significant side effects and challenges. The future of monetary policy will undoubtedly involve navigating a landscape where the unconventional and conventional are intertwined, demanding greater sophistication from policymakers and market participants. Thank you, Professor Nima, Professor Anjali, and Professor Kinzang for your valuable insights today. And thank you to our listeners for joining us on Econ Talks. We hope this discussion has provided a deeper understanding of this critical topic. Join us next time for another in-depth look at the forces shaping our global economy.
Econ Talks.